Hello, everybody. Welcome to our webinar. My name is John O'Donnell. Thank you for being part of this experience today. I appreciate your attendance. And by the way, if you have a few friends, you might want to ping them. Maybe they'd like to tune in and watch this as well. Although this will be recorded and you will be able to view it at a later date today on OTAacademy.com website. So let's talk about what's going on in the markets today. I've been part of the Online Trading Academy team since, 1998. We're going to today take a totally different look at markets, but I want to integrate the storyline or the narrative into the core strategy that Online Trading Academy has championed. But today we're going to take a look at why social mood meters matter. Now, when we talk about social mood meters, that means that there are a series of them that we have the opportunity to take a look at. And there are many meters and ways to measure social mood, emotion, confidence in a given culture. But today we're going to focus near the end of the webinar today on one specific meter. There are multiple meters, but what is the best meter that you and I can put our finger on, keep the pulse of, to become a smarter investor? So let's get into this. As a way of disclaiming it, the webinar is not intended to give you specific financial information or be an investment advisor to you. We're not a registered broker-dealer. We're not a certified financial planner. We would suggest that you consult with your own qualified professional in the area of legal, tax, financial, and investment decisions. The information I want to provide today is for education purposes only, and perhaps it will motivate you to think and act and take responsibility for your own financial affairs and make better choices, not perfect choices, but make more informed choices as these markets evolve through historically what we've talked about here at Online Trading Academy, which is supply and demand. So let's get into this a little bit. I want to start by a quote from a gentleman I have a great deal of respect for, who was part of the economic team of Ronald Reagan. He was a chief economic advisor, and his name is David Stockman. He went on to become extremely famous in private equity. I think he was one of the founders of the Blackstone Group, one of the premier financial services organizations in the world. And he recently, and I want to make sure I read this correct to you, so bear with me a little bit. He was talking in an article he wrote about the myth of buy and hold and why valuations matter. Stockman wrote that the biggest of these problems that we face for individuals is herding effect and loss aversion. Now, he goes on to say that these two behaviors tend to function together, compounding the issues of investor mistakes over time. As markets are rising, individuals are led to believe that the current price trend will continue and last an indefinite period. The longer the rise trend lasts, the more ingrained the belief becomes until the last holdouts finally buys in and the financial markets evolve into a euphoric state. I want you to think about that. Think about those terms for a moment. The herding effect, loss aversion. I want you to think about holdouts, buy-ins, euphoric states of engagement. Doesn't this ring true with what we've heard at the Online Trading Academy methodology? I remember when Sam Seiden brought to us his core strategy that the two biggest mistakes that investors make are buying after a rally in price, chasing momentum pricing into what we call a supply zone, where what awaits for them are a series of unfilled orders that are probably going to cause a pivot in price and prices will decline. The second biggest mistake that Sam observed among the investing population is that they love to sell in fear as prices decline, perhaps motivated by what Stockman talked about, i.e. loss aversion, and simply they decline into a level of what we call a demand zone, and they should be doing the exact opposite. They should be buying at the lower price, not selling at the lower price, and that action is motivated by the emotion of fear. But what was the state of the social mood of that individual before they took the emotional action of buying at the wrong time after a rally in price and selling at the wrong time after an emotional concern about loss aversion. And let's think about this term that he used, euphoric state. Wasn't it Alan Greenspan that gave us that wonderful statement of irrational exuberance? When was that? Well, if you take the time to look it up, it was in 1997. 1997, the same year that Online Trading Academy was established. Alan Greenspan is talking about the state of the market, extremes, going from periods of overbought to periods of oversold, and we called it irrational exuberance, and it's still with us. Don't we say that today? We'll compare that in a moment to what economists have used for decades, known as the efficient market hypothesis, and we're going to compare it to what is known as the socioeconomic theory of finance. You see, they're totally different, but yet I would say one impacts the other more forcefully when you and I take action. Now, why is human action important? You know, many of you who followed my work know that I am an outspoken champion, advocate of the Austrian School of Economics, created in Vienna in the 1870s by Karl Menger, brought to the United States by perhaps the greatest intellectual economic mind, in my opinion, of Ludwig von Mises. And at the end of the day, when they defined economics, they defined it as the study of human action. Well, what drives action? Is it emotion or is it something else? Perhaps it's mood. And then human action is defined simply as purposeful behavior. What is the purposeful behavior of an individual chasing price into an irrational extreme? And what is the purposeful behavior of an individual selling at a lower price, trying to avert a loss? Is it really rational? Are those actions driven by emotion, or perhaps even social mood? We'll try to differentiate those for you today. Think about this for a moment. Does social mood drive human action? Well, think about your own personal choices and decisions you make in your life, politically, financially, culturally, for entertainment, for music, clothing, trends that we observe. Let's take a look at some of this today. Let's talk about the gap between perception and reality. The standard view of the world, which is pretty much embraced by what we know as the efficient market hypothesis, is that nuclear bomb testing makes people nervous. Now, that would be considered an exogenous cause. This is an external event of somebody testing a nuclear bomb, and it makes people nervous. I'm of the age where I remember nuclear tests in Nevada. How many of you remember those days? It was very nerve-wracking, especially for people that live close to Nevada or their surrounding area. But does nuclear bomb testing make people nervous? That's the exogenous cause leading to an act of an emotional state. The socioeconomic hypothesis turns this around completely. And their statement is nervous people actually test nuclear bombs. Now let's apply this to North Korea. What is the state of mind of North Korea to drive them to test nuclear bombs in North Korea? Perhaps launching those bombs over Japan, making threats that they had nuclear capacity to hit Guam, perhaps even the west coast of the United States. And thank God some of that saber rattling is diminishing. But the socioeconomic hypothesis sounds a lot like this to me. Let's take a look at one more possibility here. Today there are threats of war, have been threats of war by several sides. Look at what's going on in the Middle East with Iran right now. Those thoughts have come back. Does war make people fearful and angry? Or the endogenous cause might be that fearful people make war. My example for this might be India and Pakistan. What has been driving that proliferation in that part of the world? And is North Korea and others, perhaps in the Middle East, driven by the leadership who are basically in a state of fear and anger, who have the capacity to take action? Big difference, isn't there? And what about scandals? Oh my goodness. We could cover this topic forever, couldn't we? Let's think about scandals, political scandals, corruption scandals. Think about the scandals of price fixing. I remember in a seminar that I did that recently some of the major financial brands in the world, through the allegations of price fixing in the Forex market, were fined over $5 billion. And I'm talking about very, very substantial organizations through the London office of Barclays, JP Morgan Chase, Bank of America. Some of the biggest and best brands in our global financial services industry settled those criminal complaints for price fixing. Do scandals make people outraged? Or that's an exogenous cause. The scandal is the external event that causes people to be outraged. How outraged were you when you heard that there was this price fixing going on? Or do outraged people seek out scandal, take political action, and cause the investigators to go find the root cause of some of these scandals? Now, I don't want to get into the current allegations of what's going on with our current administration, but if you look at the journalistic approach to why are people continuing to carry on this hunt for the scandal that drove our last election and the cast of characters that seem to be engaged anecdotally in this behavior. Is the endogenous cause is that the social mood and temperament of the public is seeking out this kind of investigation? Is this real journalism or is it yellow journalism? I happen to believe that outraged people facilitate and seek out scandals. It's certainly a variable. The standard view is that talented leaders make the population happy. Well, that's possible, but the socioeconomic hypothesis would say no, something like this. A happy population makes leaders appear talented. See, there is a difference. Does happy music make people smile? How many of you remember the beautiful song, "Don't Worry, Be Happy"? Remember that song? Sold millions of copies. Everybody had, it was a toe tapper, wasn't it? Remember that song? "Don't worry, be happy." You see, it was the happy music that, did it make me smile? Well, it was certainly a beautiful beat, wasn't it? Or the people who want to smile choose happy music. Remember, in the music charts, there are all kinds of genres of music. Some are quite buoyant, upbeat, and some are very, well, shall we say, dark. You and I have choice. The socioeconomic hypothesis says the indigenous cause of that song to become so popular and become a bestseller and make millions of dollars of profit is the social mood of the participants seeking that form of entertainment. Now, that doesn't mean everybody is happy, upbeat, in a state of irrational exuberance simultaneously, but if the net passionate actors get engaged in an aggressive way, their dominant behavior is ultimately going to identify and establish what we'll call as a trend. This one is kind of personal to me. I don't want to get too deep into this, but the standard view of the world is that epidemics cause people to be fearful and depressed. I was having a conversation with a colleague of mine before the seminar started today, and we were talking about the epidemics of SARS. We were talking about the past epidemics of AIDS, of Ebola. We were talking about the Spanish flu epidemic that killed over 20 million people. Now, obviously, when the headline news comes out that this threat threatens our population, it's certainly going to cause you and I to be concerned, perhaps even fearful and depressed. But the socioeconomic perspective would look at the internal cause, is that depressed and fearful people are susceptible to epidemics. Epidemiologists have done a lot of research on this, and they have found when people are fearful and depressed, perhaps by events that are going on in their life, they are more susceptible to disease. Their immune system is actually weakened. And there are things that we can do, of course, to facilitate and recognize this. But one cause is exogenous, the other is endogenous. It's internal to us. Now, I don't want to make the case that fearful and depressed people who had an anemic immune system is responsible for the growth of Ebola or SARS or the Spanish flu, but I want to say there's no question it's a variable because there are many people that were exposed to this flu viruses that we just discussed that weren't impacted in a negative way. This is one of my favorite indicators. It's been around probably since the 1920s, which is how do you measure social mood? Which social mood meters give us signals as to whether the public is in a state of irrational exuberance, perhaps the public's in a state of fear, consternation. And one of the favorite, very, very accurate indicators is what we call the hemline index. The hemline index. Now you tell me, when hemlines are ankle length, what do you think the social mood is? Is it, as John Maynard Keynes would say, animal spirits professed by the participants of fashion to drive hemlines to the ankle? Or what do you think that appears? Does that hemline index, and it's been repeated several times over the last 50 years, or does that represent a bull or a bear cycle? What do you think? And let's not forget that hemlines don't stay down ankle length forever, and sooner or later, we get what we call what? Well, the different indicator. This is basically the miniskirt indicator. And matter of fact, what's interesting is socioeconomists today have noticed that the baggy shorts that basketball players used to wear have become less baggy and are moving up the thigh. So perhaps the hemline indicator not only applies to women wear, but it also applies to sportswear. You see, we find during periods of irrational exuberance, people are more frisky. They're a little more excited. They do have more animal spirits, and not only is it manifested in the music they listen to, the clothing they wear, the designs in fashion, entertainment, but it's also reflected in the markets. It's also reflected in the markets. So let's talk about this a little bit more. This is one of my favorites. I've owned and operated several small businesses previous to joining Online Trading Academy in 1998. And the standard view of the world has always been that recessions cause businessmen to be cautious. And I had kind of bought into that thesis. That's the exogenous external event impacting my human action. But that didn't mean I could do a good job of forecasting the coming recession. I had to take action. Human action, again, drives purposeful behavior. I have to make choices in my business. Do I buy a competitor? Do I expand my widget factory? How do I right-size the payroll? Where do I spend marketing money? Should I perhaps accelerate the aggressive outreach for new clients? All these are going to have serious manifestations. And by the way, what is going to be the role of global trade? Are we going to have more global trade, less global trade? What are my competitors doing? You know, remember, our competitor is always a mouse click away, and it's pretty darn easy to have this exogenous perspective that the coming recession is going to cause me to be more cautious. Perhaps it will impact my savings rate. Perhaps it will impact my consumption pattern. No, the socioeconomic hypothesis goes a little bit different direction. The socioeconomic hypothesis says, no, cautious businessmen actually cause recessions by their human actions and purposeful behavior to be more cautious. Perhaps I don't buy my competitor who's in trouble across the street. Perhaps I don't expand my widget factory. Maybe I pare down my menu of products and services. And boy, I better do an efficient job of right-sizing my payroll, or I might not be around because I know my competitor is working very hard to get that done. So human action is part and parcel of purposeful behavior. But what is the dominant theme? Is it emotion or is it social mood? You see, emotion and social mood are remarkably different. Perhaps one of the best examples that we can make today using the standard view of economics is that the availability of derivatives foster a desire to speculate. You used to say that necessity is the mother of invention. How many of you remember that little statement? It's almost like carved in granite, isn't it? Well, the socioeconomic hypothesis looks at this a little bit different. From a causality perspective, they want to say that a desire to speculate fosters the availability of derivatives. The fastest growing interest in financial literacy courses that Online Trading Academy offers is not about the stock market. It's about the futures market, the Forex market, both of which are derivatives, and about the options market. And let's not forget the emergence over the last 7 years in an accelerated state of the cryptocurrency space. A desire to speculate fosters the availability of the cryptocurrency derivative. Now think about this for a moment. When did the cryptocurrency phenomenon emerge? When? 2007, right in the middle of a financial crisis. Wow. So perhaps this irrational, exuberant, animal spirits, a desire to speculate and be engaged in a new financial vehicle with incredible volatility pattern and an impressive risk-to-reward ratio emerges, and let the debate continue because we're right in the middle of it. So let's talk about what is the best social mood indicator. The standard view of the world is that a rising stock market makes people increasingly optimistic. You can see three very distinct bull markets here. The rally between 1997 and 2000, the decline between 2000 and 2002, the rally between the bottom of 2002 into 2000, the fall of 2007, the crash into March of 2009, and since March of 2009, ladies and gentlemen, we've had one of the biggest stock market rallies in the history of capitalism. S&P, this is the nominal S&P, has risen from that bottom in March of 2009 over 300% today, with a little correction around the 26th of January 2018. And what is it telling us? Well, it's telling us from a socioeconomic perspective that an increasingly optimistic herd of people make the stock market rise. Wall Street has experienced rising earnings, the emergence of the online brokerage space, Schwab, E-Trade, Ameritrade, Scottrade ad nauseum, the growth of Online Trading Academy from one center in Irvine, California to 42 centers spread over 7 countries, has certainly been the beneficiary of an increasingly optimistic population whose pattern of engagement, seeking new tools, new financial literacy skills, more engagement, has given us this picture. Because this picture that you're looking at right here is the social mood meter for the history of the Online Trading Academy community. Now let's bring up a little more clarity on this, if we may. Is it possible, ladies and gentlemen, that we are at an irrational, exuberant peak? From this particular picture, we see the declining periods driven by negative social mood from 2000 to 2002, negative social mood from 2007 into March of 2009. You see the rally from March of 2009 into where we are today, and perhaps the forecast is the coming economic hiccup driven by social mood. Now, what is the difference between social mood and emotions? Emotions are driven. Primary fear and greed we think about as emotions. They are driven by exogenous causes. When we see a hurricane, when we see, like Katrina, when we see an event like we saw recently in Houston, when we see the potential for nuclear war, you and I feel we have an emotional event, and those are triggered by something exogenous to cause a feeling. Think about that for a moment. I know the emotional feeling I get when a championship athletic event takes place and I happen to be a fan of that particular team. I admit it, I get rather emotional. When my children graduate from high school or college or they do something great, I'm so proud of them, I get very emotional. Those are external stimuli driving the emotion. Think about fear and greed as externals. But let's think about the endogenous. And what the socioeconomic hypothesis tells us is that before there is an emotional event, it will probably have precursors that are endogenous, that seed the ultimate end result. So perhaps that's where we are. I want to encourage you to get more engaged and spend some time, because the fear and greed response is certainly not going to go away in our lifetime. All of us have been on this roller coaster. If you haven't been on this roller coaster, you must be a computer, because human action is part and parcel and a major driver for our human action results and our purposeful behavior. Now here at OT Academy, we are committed to you getting on the right side of these choices, taking responsibility for your own financial affairs, because it's your money, it's your life, and it's your responsibility to take care of it. I don't think anybody listening to this webinar want to be a ward of the state or a burden on their children when that chapter of your life comes where you and I are going, either voluntarily or involuntarily, going to be forced to live out of our wealth bucket. We want to help you through that journey. And we think understanding what drives your human action is important and will help you make more informed choices. So today we have covered why social mood matters to smart investors. We want you to be smart about this. Now, my call to action is I want you to visit www.otacademy.com. Notice how we spell that, www.otacademy.com. Once you get there, you're going to find there are additional information on that site, where bonus information, I'm going to call it, where we are going to contrast financial models and compare with 10 factors the efficient market hypothesis compared to the socioeconomic theory of finance. Tell your friends about this experience. God bless you all. Good luck. Peace. I'm out of here.